Welcome to my channel, The Hidden Wealth Journey. I bet you didn't know that ETFs could be a smarter choice than mutual funds. Today, we are tackling the big debate, ETFs versus mutual funds. For years, mutual funds were the go-to investment for many. But now, exchange-traded funds, or ETFs, are shaking things up. They are quickly becoming the favored choice for savvy investors. We'll compare their fees, tax implications, trading flexibility, and more. So if you're ready to make your money work harder for you, let's unravel the world of ETFs and see if they live up to the hype. Before we dive into the thrilling showdown of ETFs versus mutual funds, let's start with the basics. What exactly are these investment vehicles and what makes them tick? In simple terms, both ETFs and mutual funds are like baskets holding a variety of investments. Think of them as diversified portfolios you can buy and sell conveniently. They allow you to invest in a range of assets, such as stocks or bonds, with a single purchase, making it easier to achieve diversification. This spread your risk approach is a cornerstone of smart investing. Mutual funds have been around for quite some time and are like the seasoned veterans of the investment world. They pool money from multiple investors and use it to purchase a portfolio of assets, aiming to generate returns for the fund's shareholders. ETFs are the relative newcomers, bursting onto the scene with a bang in recent decades. Here's where the plot thickens. ETFs and mutual funds part ways when it comes to how they're bought and sold. ETFs trade on stock exchanges just like individual stocks. You can buy and sell them throughout the trading day. It's like stock trading with built-in diversification. Mutual funds, however, operate differently. Their prices are calculated once per day at the end of the trading day. Transactions are executed at that day's closing NAV. Let's talk about a topic that might make your eyes glaze over, but is absolutely crucial to your investment returns: fees. You see, every time you invest in an ETF or mutual fund, you incur certain costs, known as expense ratios. These fees cover the fund's operating expenses, such as management fees, administrative costs, and marketing expenses. While these fees might seem like small percentages, they can significantly impact your investment returns over the long run. The beauty of ETFs is that they often have significantly lower expense ratios compared to mutual funds, and this difference can put more money back in your pocket. ETFs, particularly index tracking ETFs, tend to be passively managed. Passive management requires less human intervention and research, which translates into lower operating costs for the fund. On the other hand, mutual funds are more likely to be actively managed, meaning professional fund managers are making investment decisions, buying and selling assets to try to outperform the market. This active approach comes at a price. Active fund managers require higher salaries, more resources, and incur higher transaction costs from frequent trading. These expenses are then passed on to investors through higher expense ratios. With an actively managed mutual fund, you're paying for a driver, the fund manager, who promises to take you on a potentially more rewarding, but also bumpier and more expensive journey. Let's illustrate this with a real-world example. Imagine you invest £10,000 in both an ETF with an expense ratio of 0.1% and a mutual fund with an expense ratio of 1%. Over 20 years, assuming an average annual return of 7% before fees, you pay around £2,172 in fees for the ETF and a whopping £22,230 in fees for the mutual fund. That's a difference of over £20,000. These savings might seem small at first, but they can compound significantly over time, leaving you with a larger nest egg to enjoy in the long run. By choosing ETFs with their typically lower expense ratios, you are essentially opting for a more cost-effective way to invest your money. This allows your investments to grow more efficiently and brings you closer to achieving your financial aspirations. Now let's talk about everyone's favorite topic, taxes. We know it's not the most thrilling subject, but understanding the tax implications of your investments is crucial for maximizing your returns. When it comes to ETFs versus mutual funds, there's a clear winner in the tax efficiency department, and that's ETFs. But why are ETFs more tax-friendly? It all boils down to how they're structured and how they're traded. Remember that ETFs trade on stock exchanges like individual stocks? This trading mechanism gives them a significant tax advantage over mutual funds. When you sell an ETF for a profit, you'll typically owe capital gains tax only on the profit you made from that specific sale. Mutual funds are structured differently, and their tax implications can be a bit trickier to navigate. When you invest in a mutual fund, you're essentially buying shares of the fund itself. The fund manager then buys and sells securities within the fund's portfolio to achieve the fund's investment objectives. Even if you don't sell your mutual fund shares, you might still be subject to capital gains distributions. These distributions occur when the fund manager sells securities within the fund's portfolio for a profit. The fund is then required to distribute these capital gains to its shareholders, even if those shareholders didn't sell their shares. These distributions are typically made annually and are taxable as capital gains in the year they're received. This means you could end up paying taxes on profits you haven't actually realized yet, which can eat into your overall investment returns. ETFs, on the other hand, are designed to minimize these taxable distributions. Their unique structure and trading mechanism make them inherently more tax efficient, allowing you to keep more of your hard-earned profits. Now, it's important to note that tax laws can change, and it's always a good idea to consult with a tax advisor for personalized advice. However, in general, ETFs tend to be the more tax-efficient option for investors, especially for those who plan to hold their investments for the long term. By minimizing your tax liability, you're allowing your investments to compound more effectively and grow faster, bringing you closer to achieving your financial goals. In the fast-paced world of investing, timing can be everything. Markets can shift quickly, influenced by news events, economic data, and even social media trends. The ability to react swiftly to these changes, to seize opportunities as they arise and mitigate risks promptly, can make a significant difference in your investment outcomes. This is where the flexibility of ETFs truly shines through. Their unique trading mechanics give you the agility to navigate market volatility with greater control, allowing you to buy or sell at any point during trading hours. With ETFs, you can act on that information immediately, placing a buy order to potentially capitalize on the upward momentum. Similarly, if you see a downturn approaching or want to lock in profits quickly, you can sell your ETF holdings just as easily without having to wait for the end of the day. This intraday trading capability gives you a level of control and responsiveness that's simply not possible with traditional mutual funds. Mutual funds, with their once-a-day pricing mechanism, can leave you feeling a bit like you're driving with a handbrake on. You can see the road ahead, you can anticipate turns and obstacles, but your ability to react is limited. This lack of flexibility can be particularly frustrating in volatile market conditions, when prices can fluctuate significantly throughout the day. With ETFs, you're always in the driver's seat, with the ability to adjust your portfolio as needed, taking advantage of opportunities as they present themselves, and mitigating risks swiftly. This intraday trading capability isn't just about chasing short-term gains. It's also a valuable tool for long-term investors. It allows you to make gradual adjustments to your portfolio over time, rebalancing your assets as needed and reacting to changes in your financial goals or risk tolerance. For example, let's say you're approaching retirement and want to gradually reduce your exposure to riskier assets. With ETFs, you can systematically sell off portions of your higher risk holdings and reinvest those proceeds into more conservative ETFs, all at your own pace and without being limited by end-of-day pricing. This level of flexibility empowers you to be more proactive in managing your investments, fine-tuning your portfolio to align with your evolving financial needs and market outlook. It's like having a set of precision tools at your disposal, allowing you to craft and refine your investment strategy with greater accuracy and control. When it comes to investing, transparency is paramount. It's about knowing exactly what you own, understanding the risks involved, and having confidence in the decisions you're making. ETFs excel in this area, offering a level of transparency that's often unmatched by traditional mutual funds. One of the key aspects of ETF transparency lies in their daily disclosure of holdings. Imagine being able to see the exact composition of your investment portfolio every single day. With ETFs, this is a reality. ETF providers are required to publish their holdings on a daily basis, giving you a clear and up-to-date picture of what's inside the ETF wrapper. This level of transparency is invaluable for investors who want to be actively involved in managing their portfolios. Mutual funds, on the other hand, operate with a lower degree of transparency. While they are required to disclose their holdings, they typically do so only on a quarterly or semi-annual basis. This means you're often left in the dark for months at a time, unsure of exactly what you own or how your money is being managed. This lack of transparency can be a source of frustration for investors who prefer a more hands-on approach. It can also make it challenging to assess the fund's risk profile accurately or to determine whether it aligns with your investment philosophy and ethical considerations. This lack of visibility can make it difficult to align your investments with your values fully. The daily transparency of ETFs empowers you to make more informed investment decisions. You can see exactly how your money is being put to work, track the performance of the underlying assets, and identify any potential risks or opportunities. This level of knowledge is essential for building a resilient portfolio that can weather market storms and achieve your long-term financial goals. In addition to daily holdings disclosure, ETFs also tend to be more transparent in terms of their investment strategies and objectives. ETF providers typically outline their investment approach clearly and concisely, making it easier for investors to understand how the ETF aims to achieve its goals. This level of transparency fosters trust and confidence, allowing you to invest with greater peace of mind, knowing that your money is being managed in a manner that aligns with your investment philosophy and risk tolerance. Let's talk about a fundamental principle in investing: diversification. It's often called the only free lunch in investing, and for good reason. Diversification is about spreading your risk across different asset classes, sectors, and geographies to reduce the impact of any single investment on your overall portfolio. Think of it like this. You wouldn't put all your eggs in one basket, would you? The same principle applies to investing. By diversifying your portfolio, you're essentially creating a safety net to cushion the blow if one investment performs poorly. Both ETFs and mutual funds offer diversification benefits, but ETFs take it a step further, providing more granular control over how you diversify. Section 2. ETFs. Your gateway to targeted diversification. ETFs open up a world of possibilities for targeted diversification. They allow you to fine-tune your portfolio with laser-like precision. Want to capitalize on renewable energy? There's an ETF for that. ETFs cover a vast universe of investment opportunities. Section 3. Fine-tuning your portfolio. Sector-specific and thematic ETFs. Let's say, for example, you're bullish on the technology sector but want to reduce your exposure to energy companies. With ETFs, you could easily create a portfolio that overweights technology stocks while underweighting or even excluding energy stocks altogether. This level of customization allows you to tailor your portfolio to your specific risk tolerance and investment goals, creating a truly personalized investment strategy. Thematic ETFs, on the other hand, offer exposure to megatrends that are shaping the future, such as artificial intelligence, cloud computing, or biotechnology. These ETFs invest in companies poised to benefit from these long-term trends, providing investors with a way to participate in the growth of these exciting sectors. Imagine investing in the early days of the internet through a technology-focused ETF. That's the kind of potential that thematic ETFs offer. Section 1. Making the smart choice. ETFs and mutual funds both offer valuable ways to grow your wealth. However, ETFs consistently emerge as the smarter choice for cost effectiveness, tax efficiency, and flexibility. Lower expense ratios of ETFs can translate into significant savings over the long term. Their tax efficiency helps you keep more of your profits, boosting returns. Intraday trading flexibility allows you to react swiftly to market movements. Daily disclosure of holdings provides transparency, fostering trust in your decisions. While mutual funds have their place, ETFs offer a compelling combination of benefits. Embrace the power of ETFs and embark on a journey towards financial empowerment.